So in today's lesson, we're going to be talking about loans. When we talk about loans, the few things that you need to know by the end of this lesson are factors that influence the cost of a loan, calculating interest on a loan. You're going to know how to calculate the total cost of a loan. You're going to know the compounding interest and how that impacts loans. You'll understand the effects of interest by the length of time that you have a loan for. You're going to use the loan calculator as well, and we're going to be talking about some advantages and disadvantages of borrowing. So, what is a loan? A loan is a legal promise that you borrow. So, you borrow money with the legal promise that it will be repaid. People can take out loans for a variety of reasons. They can take out car loans to buy new cars, vacation loans, RSPs, home improvement loans. Some people might even take out loans to consolidate debt, which means that they take out a loan to pay off other existing debts from other loans or credit cards, and it kind of just puts everything into the same place. So consolidating debt can make a various payment into one payment. It can also maybe lower the interest rate. The cost of a loan varies, and it depends on several factors. The first is the amount of the loan, so how much money you actually borrowed. The length of the loan, how long you borrowed the money for, so like 10 years versus 2 years. The amount of regular payments that you make towards that loan, so how many times you pay towards your loan. The rate of interest, so how much are they charging you on top of the money you already borrowed to actually borrow it, right? And then the number of regular payments you make per year. Things that you should consider before you get a loan, and there are some key terms that you should know. The first thing is always the interest rate, right? What's a percent of your loan amount that you need to pay back every year, right? So how much is it going to cost you on top of the money that you're already borrowing to actually borrow the loan, right? The loan term, which is the length of time that it will take for you to pay back that loan. Some loan products require you to pay off loans in a certain amount of time. So say you get a loan and they're like, you have to pay this back in 3 years, or you have to pay it back in 8 years. Sometimes these loan terms can be in months. So you just take the number of years and multiply that by 12 to figure out how long your term is, especially if you're making monthly payments. So again, that brings me to the next term, monthly payments. It's that some types of loans have set payments that you must make every month. They're usually put in something called an amortization table. And while others only require you to pay minimal amounts on a regular basis, so as little as monthly interest, some might just have a set amount that you need to pay every month for the rest of your loan period. It just depends. Right? There's a few different types of loans. There's secure loans and unsecured loans. Secure loans are loans that when you put something up as collateral. So collateral just means that if you fail to pay something, that that lender now owns your property. So an example of collateral could be your house, it could be your car, it could be any other asset that you have. Some people put up jewelry as collateral as well. Unsecured loans do not require collateral. These loans are less likely to be the ones that you're going to take out. It's more likely that you'll have a secured loan, and that's because the lender wants to protect themselves and make sure that they get the money back. Penalties or fees. So some loans have extra fees that you pay on top of interest. They may also have penalties if you make late payments, or even if you pay off the loan too early sometimes. Credit card loans often have a yearly fee on top of interest. So that's an example of what that could be like. So I'm going to show you step by step how you can calculate how much your loan is going to cost you overall, especially if you just have monthly payments. This is pretty easy stuff, right? There's 2 steps. The first thing you're going to do is, okay, how long do I have my loan for? If it's 6 years, 7 years, you're going to figure that out. Then you're going to find out, okay, how much am I paying per year? So you're going to take your monthly payments, you're going to multiply that by 12, and then multiply that by the number of years that you're paying off the loan. Right? And then if you want to find out how much your interest is and how much you actually paid in interest, you're just going to take the total amount that you pay to them at the end and subtract that from the initial amount that you took in the first place. So say a bank gives you a loan of $18,500, right? They give you $18,000 and $18,500, sorry. And they say for the next 4 years, you got to pay me $430 a month, right? You want to find out how much you made and how much you paid in totals. So even though you're paying $430 and it's spread out over the course of 4 years, let's see how much you ended up paying. So our step 1 is going to be find total cost of your loan. Right? Using this equation. So your total cost, or your A, right, the amount you owe, is going to equal monthly payments times 12. So if you're doing a monthly payment, it'll be times 12, or like if you're doing quarterly, it'll be however much it is, times the number of years. Okay, so we're going to do that. I'm just going to highlight this so that we know it's just our text. So let's do that. I know that my monthly payments, they said, were $430. 12 months in a year, so I'll make 12 payments times how many years? It was 4 years. So I'm going to do 430 times 12 times 4, which is going to give me $20,640. That means that when I go to pay off my loan, right, at the end of everything, I will owe the bank, or whoever I borrowed from, I will owe the lender $20,640, and that's how much I will have paid. I will have paid them that much, right? So I paid the lender, would be better. It's just you took that $20,000 and instead of paying it all as one lump sum, you paid it off over the course of 4 years, right? So step 2, if you want to know how much you paid in interest, figure out if you want to figure out how much you paid in interest, very simple. You're going to take just our formula from the last one. Interest is equal to the amount you paid in total minus the principal. So we ended up paying $20,640, and we had initially only taken out $18,500. So if you do the math, you ended up paying $2,140 in interest. So therefore, paid $2,140 in interest. So I'm going to have you try to do the next one by yourself. So pause the video here, try to go through it by yourself, right? And then come back and take it up with us. All right, so hopefully you pause the video. It says, what is the amount of interest that's paid on a 5-year loan, so that's our years, of $20,000, that's my principal, with a monthly payment of $404.57. So we're going to do step 1. We're going to find the amount of our loan. So the amount of our loan is going to be $404.57, right? That's our monthly payments times the 12 months that we're going to pay for times the 5 years. That's going to give us a grand total of $24,274.20. So that's our answer. So that's how much I end up paying them at the end, right? This is asking me what's the total amount of interest that's paid. So I got to take another step and I got to find the interest. So interest is equal to A minus P. So I'm going to do 24,274.20 minus the initial 20,000 that I borrowed, right? And I ended up paying $4,274.20 in interest. Therefore, $4,274.20 were paid in interest. Cool. And that's that. That's how you do these kind of questions. So I'm going to have you pause the video here. If you haven't done so already, go through and try doing these questions. I will post the answers to Google Classroom, but this is kind of like homework problems. You use the same idea as what you would do for the rest of them, right? You're going to go find how much you have to pay as a monthly payment, find out how many months there are, so there's always 12, right? And then find out how many years there are, multiply Find that amount that you're going to pay and then figure out what the interest is. Okay, and I'll post these answers to Google Classroom. Just at the end, the one thing that I do want to talk about is this last question that often a lot of people don't realize that you can do. So there's some aspects of borrowing money that we actually can control, right? So there's a few things that we can do in order to ensure you don't pay too much extra on your loan, right? So these are the few things that you can do in order to make sure that you don't pay too much extra, right? You can increase your monthly payments. So if you pay more over a shorter period of time, right, you end up paying less interest. Pay more over less time equals less interest. And we saw that with our credit cards, right? If we paid more than the loan, if we paid more than just the minimum payment, which they required us to pay, versus like paying like just the minimum payment, right? You notice that the more you pay over the less period of time, the less interest you spend on it. Pay off as much as the principal as you can, right? So that's the same thing. Pay as much as the monthly payment as you can because you're going to pay off as much as the principal as you can, and obviously having lower interest. As the interest rate gets higher, the amount of money that you need to pay off towards your loan becomes significantly higher. Okay? Alrighty. So now we're going to talk very quickly about getting a loan. So how do you actually get a loan? Because everybody says like, okay, like you're going to get these loans. How do you actually do it? So all types of credit that you might use, such as credit cards, car loans, personal loans, mortgages, lines of credit, all become part of something that is known as your credit history. So whenever you go to apply for one of these, you actually apply for a loan application or a credit card application, right? And that credit card application keeps your social insurance number. That social insurance number is linked to your credit history. Your credit history can be found through a credit report that tells you a few of the following things. It tells you what your credit score is, gives any personal information, where do you live, what do you do, how much money you owe and who you owe it to. It gives you your credit limit, right? And whether or not your bills are paid on time, and if you have any credit cards that are not maxed out or paid. I highly recommend at some point figuring out and looking at your credit history. I think the first time most people look at it is when they go to get a loan and don't even realize that they have loans out at that moment that they haven't been paying. So it's definitely something that's worthwhile checking out. It also protects your credit card from fraud, right? Then the other thing is who is actually allowed to see your loan. So obviously, or your report, obviously lenders. So anybody who's going to give you money is able to see your credit history. Employers, I've never had an employer ask me, but an employer could ask you for your credit history. Landlords, which makes sense because they're about to give you their rental property. And sometimes insurance companies as they want to see how high risk you are. In Ontario, before anyone checks your credit scores, they need your consent. So if you don't feel comfortable giving your credit score to somebody or you don't feel comfortable sharing that with anybody, you are legally allowed to deny them the access to that stuff. What is your credit score that we've been talking about? So your credit score is this 3-digit number, right? It determines information in your credit. It's determined by the information in your credit report. It shows how well you manage credit, right? And how risky it would be to lend to you. So a credit score is kind of just like the bank's way of knowing that you're good for the money, right? It's kind of like someone who vouches for you, says, hey, trust him, like they're good for the money. So that way, when a bank lends you money, if you have a good credit score, it's not like, oh, that Miss Singh, she never gives me the money back, you know? They know that they should be able to trust you. Which is why having credit and having credit cards are important, or having loans is important, because if you've never borrowed money, the chances of you being able to somebody granting you $10,000 is highly unlikely, right? So if I know that, you know, I have a client who's been borrowing money religiously from me, $500 here, $200 there, $300 there. When that person comes and asks me for $10,000, I'm more likely to give it to them rather than a client who's never borrowed money from me. I have no idea whether or not they're good for it and whether or not they'll pay it back, right? So that's why a credit score is important and why it's important to build that credit. So what is a good credit score? A good credit score is basically anywhere. So your credit score can range anywhere from 300 to 900, right? The higher your credit score, naturally, the better it is, right? So if you have a score of 800 to 900, you're probably in good shape. You'll probably get a loan, right? There's a few ways that you can make sure you keep your credit score high. So there's a few things that actually affect your credit, and it's like a lot of things. But mostly it just depends on how you manage your money and how you repay your loans. So a few things that might affect your credit score are how long you've had credit, right? So the younger you start off, the better. So as soon as you can, you should start building your credit. How long each credit has been on your report. So try to pay off your loans ASAP, right? So if you took out $500, I don't know, 6 years ago on a credit card, and you never paid it off, or you're like slowly paying it off with minimum payments, that's going to show up on your loan. So try to pay them off as soon as you can. If you carry a balance on any of your credit cards, so are you actually carrying balance on your credit card right now? If you've ever missed payments, and surprisingly enough, this includes phone bills. It includes your Spotify, your Netflix payments, right? So be careful with that one especially. The amount of outstanding debts that you might have. So if you've borrowed a lot of money from multiple places, that will lower your credit score, and haven't paid them off. Being close to or above your credit limit. So if you have a $5,000 credit card, the general rule of thumbs is 2/3, right? So only go up to 60% of the $5,000 limit. So if your limit is $5,000, try not to go past $3,000 on that card. It just looks bad. The number of recent credit cards or loan applications you've applied to. So if you're applying to a bunch, that might be a little bit suspicious. The type of credit that you're using. So are you using high interest credit? Are you using low interest credit? Are you using high interest credit cards and nothing else? No line of credits. If your debt has been sent to a collection agency, also really important to remember, parking tickets can be sent to collection agencies, so they can show up on your credit report. So while technically somebody tells you legally they can't arrest you for not paying your parking tickets, it can negatively affect your credit. Any record of insolvency or bankruptcy, right, also goes to your credit. So what is the point of having a better credit score? There's two reasons that you should having a better credit score matters. And they're two pretty important reasons, because there's two reasons that you're going to use in your day-to-day life. When it matters, you're going to get a better loan, right? So it might not matter now because you're like, I don't need a loan, so I'm not going to build my credit, right? But when you need a loan, and should you need a loan urgently, right, you will get a bigger loan. So when you buy a house, when you decide to buy a car, for whatever reason that you need to take a loan, if you need to pay off bills, whatever it might be, you'll just get a better loan. The other thing is you'll get better interest rates. So surprisingly enough, the more you borrow and pay back money, the better interest rates you'll get, versus if you're not good for the money according to the credit bureau, you might not get as good of an interest rate. You might get something charged higher. So when you're applying to credit cards, you'll notice that there's some low interest credit cards. Those low interest credit cards will only be allowed to apply to if you have a good credit score. So types of loans. So we talk about a secure versus unsecured loan. When you apply to loans, you'll most likely only get secure loans. One of the most popular loans for young people is a student loan, naturally. Most students in Ontario, if they attend a university or college in Ontario, or are permanent residents of Ontario, will apply to OSAP. OSAP is the Ontario Student Assistance Program. And in order to apply to OSAP, you must be a student who lives in Ontario for at least 12 months and a Canadian citizen. This has actually changed to also include permanent residents, right? OSAP offers you two types of money, I would say, right? The first one is a grant, right? That's money that you do not need to pay back. And then you have student loans. When you apply for OSAP, you're automatically considered for both grants and loans. And if you don't want the loan because you're like, I don't need this debt, right? You can actually decline the loan, say, hey, I don't want it, take it back, and your school will give you the grant instead, right? The grant is obviously less than the loan because you don't need to pay it back, but it's still free money. Your school must also be an OSAP approved school, right? The link for OSAP and how to apply is listed below. So when you do go on and apply to university college next year, this is definitely something you should check out. It's a great resource for you to know like who can apply, what are some OSAP approved schools. The biggest misconception that even I had when I was applying to OSAP is that if I applied to university or college outside of Ontario or even outside of Canada, I wouldn't get approved for OSAP. That's objectively false. There are some schools that are international, very limited, but there are some schools that are international that fall under the preview of OSAP approved loans. So it's definitely worth checking out on their website. So that's something to consider if you decide to go to school in the States or if you decide to go to school in the UK. Other ways that you might be able to fund your education, right? If the OSAP is actually largely dependent on your parental income, and as well as your family income. So if you are in a family full of 6 people and you happen to be the youngest person, all of their income goes towards how much OSAP will give you, and even if they're not contributing to your education. So there are other ways to fund your education. Sometimes it's through student lines of credit. Most large banks offer them. I know CIBC, RBC, and TD and Scotiabank do for sure, but there are multiple banks that offer them. Another thing would be if you have a home or a property that has equity in it, you can actually pull out the equity in your house. You can refinance it. You can have a second mortgage, right? You can get private loans. These private loans often charge a ridiculous amount of interest, so they're not really recommended, but you got to do what you got to do. Or you can get personal lines of credit or personal loans just from the bank and use that as your student payment. So now that you've gotten this loan and you're like, okay, I have it, sweet, let's move on, right? What happens when you got to pay it back? Most loans are compounding interest loans. You need to be careful when you're thinking about paying them back, and you need to make at the very least, the minimum payments. And the reason that this is the minimum payments are set up by the bank in a way that you're at least paying off some of the interest and some of the principal. Because if you just let the interest accrue, you start getting charged on the interest. And some people end up paying so much more than they originally borrowed because they got charged interest on the interest, right? Compounding interest loans are often compounded at a different compounding period. And the way you calculate loans is very similar to the way we calculate our compounding interest payments when we're paying back credit card payments. It's basically the same thing. When you're lent money, you're either given a loan at a fixed rate or a variable rate, and we'll talk about that. If you're calculating with a fixed rate, the calculations are pretty easy. They're listed below. So we're going to focus on calculating with fixed rates in this class. When I show you how to use the loan calculator, you can actually calculate with a variable rate as well, or a floating rate as they would say. So the prime rate right now in Canada, according to TD, is 2.45. That's the one at most banks. Each bank has a different prime rate. Each bank has... and the prime rate fluctuates. So sometimes it goes up, sometimes it goes down. Right now, because we're in the middle of a pandemic, it's actually pretty low just because of the economy. But sometimes it goes high. So it just depends on what the banks are looking like. Okay, so the steps, again, if you look at this, really similar to our steps for calculating compounding loans on our credit card. The first step is find the end value, right? Compounding periods per year. So with the credit card, it's always going to be 12, but sometimes with the loan, it might not be. It might be quarterly, it might be daily, could be a different amount of reasons that it might be different depending on where you get the loan from. More often than not, it is 12 though. Right, same thing here. Then you're going to calculate the I value. You're going to take the APR in decimals and divide it by the number of compounding periods per year. In this situation, I highly recommend that you use that table from lesson 2, the compounding interest table that gives us all of our compounding interest formulas. Okay, then you're just going to take your I, your N, and your P, and you're going to plug it into that equation and find the value for A. And if you want to find interest, you're going to do A minus principal. So let's do a question together. So this says, Dylan takes out a personal loan of $5,000 from the bank. I know right off the bat that my P is going to be 5,000. So just write down what you know. It's compounded monthly. That means that I have 12 compounding periods. Right? Because there's 12 months in a year. Periods per year. The interest rate is prime plus 1. So I'm just going to pull this out and do this somewhere else. Just going to box that in. And you have agreed to take 5 years to pay that off. Right? So first things first, let's go find our N value. So if we go back to our chart, it says N, if it's compounded monthly, is the number of years times 12. So let's do that. Number of years times 12. So the number of years here is 5 years. We're going to multiply that by 12. So our N value is 60. right? We got our N. The next thing we're going to go look for, step 2, calculate the I using the formula APR divided by number of compounding periods per year. I is equal to APR, right? Which we don't know yet. Plus, divided by number of compounding periods per year was 12. The way for us to find APR, and I'm just going to do these calculations over here, off to the side somewhere. If it's asking for prime plus 1%, you're just going to take whatever the prime was, which was, I think I said 245, plus 1, which will give us 345. So our annual percentage rate in that year is going to be 3% and 3.45%. So then our APR is going to be 0 point, and I'm just going to take 3.4% and divide it by 100. And that's going to be my annual percentage rate. So it's going to be 0.0345 divided by 12. Right? And then just go into your calculator, throw that in there, and it should give you 0.002875. So I'm going to say I is equal to 0.002875. That's my I value. So I have my N, I have my I have my P, right? And now I'm just going to go and plug it into the equation. So A is equal to P, 1 plus I to the power of N. So I'm just going to plug in what I know. I have 5,000, 1 plus I is 0.002875 to the power of N, which was 60. So I have 5,000. 1, do whatever's in the bracket first, so 0.002875 plus 1 is just 1.002875 to the power of 60. Next up in exponent, in BEDMAS is exponent, so do that number to the exponent, 60. I just did this all in one step, so I multiplied by 5,000 right away. So I did 5,000 and put it all in one step, so I can show you how to do that. So I'm just going to go here and just pull up the scientific calculator, right? So I did 5,000 times 1.002875 to the power of 60, and I did it all in one step, and I got 5,939.8888. So I just rounded that up to 89. So then my answer here was $5,939.89. So that's how much I'm going to have to pay at the end of my loan. So therefore, must pay $5,939.89 at the end of your loan. If I want to know how much I paid in interest, I just need to go in and say, okay, interest is just equal to A minus P, right? Which I'm going to say is 5,939.89 minus the original amount we had borrowed was 5,000. So I paid $939.89 in interest. Therefore, paid $939.89 in interest. And always write your statements because that's important. So this is really similar to the way that we found our compounding interest on the last one. Okay. The only thing here is if you have the APR, you just need to make calculator first. Okay. So I'm just going to pull and draw our attention to this last thing. So another tool that you can use, and it kind of does the math for you, which is nice, is a tool that we can calculate our loans with. It's from the CanLearn website. The hyperlink is attached in your file as well. This tool is super easy to use, so we're going to use the tool to do a few examples just so you get a hang of it. So the first one says that I clicked on it and it takes me to this thing right here, right? So this will help you solve all of your student debt problems, right? Student debt actually is one of the number one leading causes of insolvency, so just be careful when you're taking it out. And it's good to have this tool to know how much you'll end up paying a month and how that falls within your budget. So it's a great tool. This is actually the tool they link to you when you start repaying your OSAP. So it's a good tool, and it's a great way to like compare your options as well and find out what sustainably works for you. So let's do the first one. It says Lily decides to take out an OSAP loan. Since she graduated this year, she was stuck between deciding whether it was smarter to have a fixed or floating interest rate. Her loan was $50,000 at the end of her 4 years, and she decided to jump on payment and start paying right as she graduated before the interest started to accrue. So with OSAP, you actually have a 6-month grace period where the interest doesn't accrue, right? But you can start paying off your loan right then. So if you have a job right out of undergrad or out of your college experience, you can start paying off your loan almost immediately. Right? And it's almost worth it because there's no interest on it. So you're paying directly to your principal. You're directly paying off the loan so that when they do start charging interest, they're charging it on something smaller. Right? So let's try this out. So it says, I just have it open up on my computer. So it says she has a $50,000 loan. Right? She wants either a fixed or a floating rate. So let's say it's fixed. Prime right now is 245. She wants to start paying her loan immediately. And it says select the number of months you need to repay your loan. So she wants to take 5 years. So we need to turn the 5 years into months by doing 5 times 12. So she wants to take 60 months to pay off her loan. Same thing over here, 50,000. And this one we're going to change to floating. Everything else stays the same as it was before. And she wants to take 60 months. So same time, just different interest rates, either fixed or floating. So with the fixed rate, which is going to be 2.5% always, 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 she's probably going to end up paying off her loan in 60 months. She's going to have to pay a monthly payment of $911.49 every month, right? Over the course of her loan, she will end up paying $4,689.62. So for a total payable that she will have and eventually end up paying to the bank to OSAP, $54,689.62, just right here, right? So if you look at the bottom and right there, here if she has a floating rate just basically means that the rate can change, varying depending on whatever prime is. So if prime goes down, it's good for you. If it goes up, it's a little bit more dangerous. So you can actually end up paying more, but this is how much it is as a guesstimate. So if you had a floating interest rate and you started paying off your loan immediately after school, right, you'd pay it for 5 years. The total amount you'd owe is $50,000. The amount of your monthly payments would actually go down, so it would be $875.96, and then over the course of your loan, you'd actually pay a lot less. You'd pay about $2,557.49. So for a total payable of $5,257.49, right? So in this situation, you can just go back and write those numbers in. So I'm just going to go ahead and write the numbers in, right? So how much did she pay in monthly payments? She paid $911.49 here. And there's no math that's required here. You just need to go read the chart and see what it's asking, right? For her first option, she would end up paying $4689.62, right? And then for the floating interest rate, she ends up paying $2,557.46. $2,557.46. Right? And how much would she have to pay at the end on top of... Oh, sorry. This is how much she'd pay in interest. So then you just need to add however much she's paying in interest to the $50,000. So then she'd pay 689.62 here, and then she'd pay 52. And you can just read that from the bottom here, where it says total amount payable. Or you could just add the interest. Either way works, right? Which one would you pick and why? You might have a variety of reasons why you'd pick different ones. I personally would pick the floating, but it is more risky. The chances that the prime rate will go up are possible, right? So you might end up paying more. Just, it depends on whatever works for you in that moment. If you have a high prime rate going in, you might choose to pick floating because you think it'll drop. If you have a low prime rate going in, you might say, you know what, I don't think the prime's going to drop any more than this. Let me just fix it at this, and so that I just know how much I need to pay off, right away. So Jillian went to university in the US, and unfortunately one of her universities wasn't covered through OSAP. She needed to take out a student line of credit with CIBC. She needed to still take out $50,000 in loans and decided to pay it back at a fixed interest rate of 6%. She plans on taking 8 years to pay it back. Answer the following questions using the loan calculator. How much would she pay each month in monthly payments? How much would she pay in interest? And then how much would she end up paying in total? Right? So let's go in here. You can actually just go back and change just one thing or a couple things about your loan. So the only thing we're changing here is we're changing this to fixed. I'm going to leave option 1 as the same as we always had. I'm going to change this to fixed, and I'm going to change our prime rate. I'm going to change this to 6%, right? Because that's our new interest rate. I'm also going to change the number of years that she's paying off her loan. Because it's at a higher interest now, she's going to spend 8 years. So I'm going to do 8 times 12, which is going to be 96. And we're going to calculate that. So now our option 1 is still our original 2.5%. Now we're going to move on to option 2, which is our $50,000 at fixed at a 6%. She increased her term loan, right? Still owe the same amount of money. But now her monthly payments have gone down if she takes longer to pay it off. So it'll be $680, right? So her monthly payments for her new loan will be $680.14. $680.14, right? And let's see how much you'll pay in interest. So total interest payable over the life of your loan will be $15,293.53. Compared to, if she had taken OSAP, it would only be $4,689, right? So you're definitely paying way more interest over time. So I'm just going to go here. $15,293.53. How much would you end up paying at the end? So you just add that to the 50,000, or you could just go back here and it'll actually tell you what it is, 665,293.53, whichever way you want to do that. I'm just going to use the number that they gave me because they already did the math for me. So then Jillian hears from one of her friends that if she actually paid more in monthly payments over less amount of time, that she would save money in the long run. How much more would her monthly payments be if she decided to go with the 6-year option, right? And then how much more would she save in that situation? So let's go back to our loan here, and we'll leave this one here, and we'll go change our initial OSAP loan because now we're still paying $50,000. We're still doing fixed, but we're going to change our interest rate from OSAP to the CIBC one, which is 6%. Right, we're starting right after school finishes, and now she is going to take 6 years, so 6 times 12 is going to be 72, right? And she's going to start paying immediately after. So calculate. So you'll notice here, this is the 6-year option, option 1, and option 2 is the 8-year option. Notice how, even though the percentage is the same for the prime rate, right, and they're paying it back at the right time, just by decreasing the number of years that you take to pay back your loan, right, look at how much interest changes. You go from paying $10,000 in interest to $15,000 in interest. So that's a pretty big jump. So how much your monthly payment will be is also a pretty big jump. You're going to go from paying your regular $680.14 to paying $843.83. So let's go put that in. Let's do the math. So it's $843.83 minus how much you would have paid otherwise, which would have been $618.14, right? So if we want to find out how much more she's paying, you're just going to subtract them. So you're going to do $163.69. So she ends up paying $163 more per month. Therefore, she pays but think of how much she saves instead of doing it over 6 years versus 8. So let's go look at her interest. So in 8 years, she pays an interest of $15,292, right? So that's how much her interest is going to cost her. In 6 years, she's paying $10,756.04, right? That's a lot of money that she's saving there. So let's go through and say, okay, so if she went from paying $15,293.53 in interest minus 10,700. So I'm just going to actually put that into my calculator. 53 minus 10,759.04. I'll just go write it in here. If you do the math, you end up saving $4,000, $573.49. So you end up saving almost $4,500 by paying off your loan sooner, right? So you pay less towards the bank. And that's important for us to recognize. That's why the length of time of a loan can really negatively impact how long you pay off your loan, which is why they tell you, and it also impacts your credit score. Like the longer you take to pay off your student loans, the longer it impacts your credit score. So it just makes, if you can, pay it off as soon as you possibly can, which is why a lot of people opt for co-op positions, right? Because you can start paying it off as early as right after you graduate from undergrad. Another thing that I actually want to point out to you, so let's say they have the same return loan, right? So one thing that people don't realize is that the 6 months after you graduate from high school or from undergrad or from whatever you finished, so I'm going to change it back to a regular prime rate, which is $245, right? When you graduate from your post-secondary education, there is, for OSAP, a 6-month grace period. And a lot of student line of credits now also have this, right? With that 6-month grace period, what happens is they don't actually charge you interest right away. So you can, when you're paying those payments, you're paying directly towards your principal. So you can actually reduce the principal amount that you're using. So here, let's compare this option where this person started repaying right after her loan, and this person waited that 6 months before they could repay their loan, right? Same term, same number, same rate, same fixed floating interest, all of that stuff, right? This person who decided to start paying right after they finished their loan has lesser monthly payments, so it's $606. They'll end up paying less over time. Almost 9518.64 minus 8250.86, right? They'll end up saving $1,267.78 over the course of their loan for the same loan, same percent, same time, right? Just because they started paying it a little bit earlier, and that's because that they're taking that off right off their principal, right? So they're not even paying interest at that point. So now when you go to reinvest it and you compound it, it's going to be less, right? So like instead of starting off with $50,000 at 2.5%, this person, if they're already paying $6,678 for 6 months, they will have already taken off of their loan $3,640.68, right? So when you take off 50 minus whatever that number was, instead of having $50,000 when your loan starts to compound, you're starting with $46,000. So you just save money like that. Okay, so that's it. That's the end of this. You have your finance assignment. You actually do have a question like this on your finance assignment. You shouldn't use the loan calculator won't help you with that one. You have to do it by hand because they're not making any payments. But this is a really good one when you actually decide to pay off your loans. Okay, all right. Thank you. Have a great day.